Lesson number 1. Never enough. One day, a fisherman was lying on a beautiful beach, with his fishing pole in the sand and his line cast out into the sea. About that time, a businessman came walking down the beach, trying to relieve some of his stress. He noticed the fisherman sitting on a beach and decided to find out why this fisherman was fishing instead of working hard to make a living. "You should be working rather than lying on the beach," said the businessman. The fisherman looked up, smiled and replied, "And what will my reward be?" "Well, you can get bigger nets and catch more fish," was the businessman's answer. "And then, what will my reward be?" asked the fisherman, still smiling. The businessman replied, "You will make money and you will be able to buy a boat, which will then result in larger catches of fish." "And then, what will my reward be?" asked the fisherman again. The businessman was beginning to get a little angry with the fisherman's questions. "You can build up a fleet of fishing boats and let all your employees catch fish for you." Once again, the fisherman asked, "And then, what will my reward be?" The businessman was red with rage and shouted at the fisherman, "You can become so rich that you will never have to work for your living again. You can spend the rest of your days sitting on this beach, fishing and looking at the sunset." The fisherman, still smiling, looked up and said, "And what do you think I'm doing right now?" Later that day, the businessman was arrested. He was doing illegal investments to earn a few millions. Yet, this man already had millions earned with hard work and honesty. But he wasn't satisfied. He wanted to become a billionaire so badly that ended up losing everything. In the next day, the fisherman saw him on the news and told to his son, to make money he didn't have and didn't need, he risked what he did have and did need. And that's foolish. Son, find your financial goal and when you reach, put a stop. There is a point where more money doesn't mean more happiness. Lesson number 2. Tails, you win. By the end of his life, a famous art collector had more than $1 billion worth in his collection. Yet, when he was younger, he didn't show any particular talent. Art is very subjective, so how did this man foresee early in life which would become some of the most expensive pieces of art in the world? Some say it was skill, some say it was luck. But there is a third explanation, one very relevant to investors. During his life, he bought vast quantities of art, and even if 99% became of little value, the other 1% proved to be great acquisitions. He could be wrong most of the time and still end up stupendously right. The same can be seen in other industries. When a venture capital invests, it doesn't invest in one or two companies, it invests in multiple. And in each 50 companies they invest in, they likely expect half of them to fail, 10 to do pretty well, and 1 or 2 to do exceptionally well, compensating the losses from the others. We are not art collectors or venture capital owners, but most of us are interested in long-term investments. However, most people struggle to know when it's the right time to invest. Should we invest regularly regardless of the price, or should we wait for the best time where the price is the lowest? To answer this question, let's look at 2 hypothetical investment strategies based on the last 20 years of the S&P 500. 2 friends agreed to invest $2,000 each year for 20 years. The first friend managed to invest on the stock market's lowest day of the year every single year. The second friend had some truly bad luck and always invested in the highest day of the year. We can obviously expect the first friend to have a better return, but how much better was it? After $40,000 invested in 20 years, the first friend had a return of $150,000. While the second friend, despite his bad luck, made a pretty solid return of $120,000. Not that much of a difference, right? We can see from this example that in the long run, today is not that important. Consistency is. Lesson number 3. Getting wealthy versus staying wealthy. If you had $100 million, what would you do? I know it's not your case, but a staggering 70% of people would lose it in a few years. Why? Most people believe to be rich, they just need to earn money, but everyone forgets you also need to know how to keep it, or else you will end up with less than you had. A lesson Jesse Livermore never learned. Jesse was born in 1877 and became a professional trader. By the age of 30, he was worth the equivalent of $100 million today. Jesse was a natural at making money, until one day the stock market crashed. It was one of the worst days ever, and Jesse's wife feared the worst. But Jesse arrived home that day, and he was happy. In fact, he was the happiest he had ever been. In a stroke of genius, Jesse bet the market would crash and not only saved his fortune, but better. He made the equivalent of $3 billion that day. In just one day, he became one of the richest men in the world. Although Jesse was the best at making money, he was not that good at keeping it. After that magical day, Jesse became overconfident and started making larger bets. He ended up increasing his debt and eventually he lost everything. Later, sadly, he took his own life. Most people are so focused on making money that they forget you need to keep it as well and end up losing what they already have. You see, making money requires taking risks, being optimistic and putting yourself out there. But keeping money requires the opposite of taking risk. It requires humility and fear that what you have made can be taken away from you just as fast. A lot of people study Warren Buffett. They focus on how he made so much money, but not many try to learn how he kept it. He never carried debt. He never panicked and sold in a recession, and he didn't focus only on one strategy or passing trend. Getting money is one thing, keeping it is another. Lesson number 4, surprise. If you did like the two friends on the lesson number 1 and started investing in the S&P 500 20 years ago and reinvested all your dividends, you would get an average return of 9.6% per year, which is insane in my opinion. In fact, investing in the S&P 500 has been so stable in the long run that the average return of the last 150 years is about 9% per year. Now the question is, will it continue like that in the future? From the outside, the S&P 500 seems regular and consistent, like nothing has changed. But from the inside, we can see that the S&P 500 is nothing but the same. It has dramatically changed over the years, not only itself, but all the other things around it that determine its growth. Laws are changing all the time. The economy changes a lot too, and so many other things that highly impact the value of the stock market. 50 years ago, there were no tech companies, and nowadays they represent more than 20% of its composition. The time between US recessions has also changed dramatically over the last 150 years, and many other variables will contribute to a future that may or may not be different than the past. So, to answer the question if it will continue to rise, the reality is we don't know. However, people continue to make predictions based on the past. Don't get me wrong, history can be very insightful, but did you ever notice that the most impactful events are the ones that are not that predictable? Take the 9/11 as an example, which brought the stock market 14% down. Who could predict it? Or the dot-com bubble? Or the Russian-Ukraine war? You see, these events had a major impact in the economy and the stock market, yet no one knew they were going to happen. The world changes and it changes fast. History can be very insightful, but we should always expect the unexpected. Lesson number 5. When you will believe anything. I know what will happen is a dangerous thing to say. Looking at history and trying to predict the future is one thing, but developing a story to convince yourself you know what will happen is another. And I have done it. It was about Bitcoin, but it could have easily been about stocks or commodities. At the end of 2017, I saw Bitcoin growing 3 times its price in just a couple of months, going from $6,500 to $20,000. Then I saw it drop hard. In just 1 year it reached its bottom at $4,000. It seemed lost, dead. But then, month after month, it slowly grew. Until the end of 2020, it exploded again to 3 times its previous all-time high, reaching an astonishing price of $60,000. After a year at its peak, it went down big time, again. After witnessing such events, I developed a story in my head, that Bitcoin is cyclical. After every all-time high, sooner or later there will be a big drop. Then a slow rise for a couple of years, and finally a crazy rise to a new all-time high. So all I have to do is to bet strong when everyone believes it's dead during its slow rise, and wait for the next boom to emerge. But that, as I said, is just a story in my head. It's not real. It doesn't mean it won't happen, but there are multiple factors that can completely change the trajectory of its price, regardless of its past. I don't have economic or psychological studies to back it. I just really wanted it to be true. And the more we want something to be true, the more likely we are to believe a story that overestimates the odds of it being true. We like to feel control. Believing a story helps us sleep well at night and reduce the fear of failure. But as we have seen, the most disruptive events are not predictable. Something can happen and kill the credibility of cryptos, driving its price to ashes. Everyone has an incomplete view of the world, but we like to form a complete narrative to fill in the gaps, and that can be very dangerous. Wish me luck. If you want more videos like this, subscribe and like, that usually helps my channel to grow. See you in the next video.